All right, let's go ahead and get started. My name is Jeff Bruskin. I'm the founder of White Tiger Connections. We are a brokerage firm. We also do talent acquisition and monetization of strategic partnerships in the accounting arena. Public accounting is our specialty. Um, Mergers and acquisitions is our specialty specifically. So today we're going to be speaking about deal models. And topic of this is going to be, or the structure rather, is going to be about 15 minutes of lecture on the topics at hand, and then about 15 minutes of Q&A. So if anybody attending has questions, please feel free to ask. So for starters, I'd like to talk about the difference between the merger and the acquisition, which is the M and the A in the acronym. So I think it's a good place to start. Primary difference between a merger and an acquisition, and this is true in all sectors as well as in accounting firms specifically, is that in a merger, there's no money which is exchanging hands between party one and party two. And in an acquisition, one party is being exited, so it's a liquidity event. In a merger, you have a reassignment, a reallocation in value of each company's respected equity or stock into a common value of equity and stock. And in an acquisition, you have the liquidization of the seller's stock either all at once or more commonly over a period of time. So that's the primary difference between M&A. I'm going to go into some structures specifically in more details. So the biggest thing that we run into with our clients, both buyers and sellers, is expectations around more money up front in an acquisition versus less money up front. And I'd like to talk about some of the reasons why there's either more or less cash up front, some of the norms of behavior, and why this is specifically in the accounting industry, things work the way they do. Recently we sold a company. I'm going to use this as an example. It was an accounting firm for approximately $6 million. It's a lower middle market accounting firm. And in this situation, the seller got about 45% of that, about $2.8 million in cash up front. Now, this is a very large amount of cash up front for the accounting sector. Typically, what we see from a cash up front standpoint is between 10 and 33% of the value of the transaction is paid in the acquisition context to the seller up front. We get asked a lot of questions by sellers why it's not more. And the easiest answer for that is in accounting, like other services businesses, the real value of what you have as a seller is the goodwill, the perception of value that your clients have on you. So for buyers, of course, are buying that goodwill, and they want to see the actualization and the consummation of that goodwill going from your brand over to the buyer's brand, which obviously happens over a period of time and necessitates your continued involvement in the practice in some way, shape, or form, right? Whether limited or on a dedicated basis. So the reason why almost always in accounting M&A, you have less than half of cash being paid up front. The reason is because that second half of the value of your practice is tied to the retention of your clients and also the consummation of your clients being rolled up into the buyer's strategic vision for your clients. And we're going to talk more about that as we get into the difference between additive buyers, multiplicative buyers, and exponential buyers, which we're going to get into in a couple of minutes. More cash is paid up front in deals where buyers really want your business if you're a seller. And, I'm sure that's not surprising to you. More commonly, as I said, we see 10 to 33% of cash paid down. That's more typical. And then, there are situations where we even see zero cash down or maybe the 10% situation. And why is that, you may be wondering? The situation where that really works to a seller's benefit is where a seller is not looking to exit from the company. They're looking to almost like a soft merger where there's maybe a longer term succession plan and they want to continue working either for an open-ended period of time or for 5 to 10 years, let's say. Even 3 years is enough time that a longer tail vesting cycle in the consummation of your equity could be sensible. Something that I'll just touch on briefly here is if you're going to continue working as a seller in the combined firm after the exit of your practice, um, you're very likely going to have a salary, right? So a lot of times I have sellers who are nervous about what their compensation is going to be like post integration. And that makes a lot of sense. You're being paid for the equity in your practice. But if you're continuing to perform, to manage client relationships, to help with the review of technical work, even to just massage your clients and fold them into the buyer's vision for your practice, you're going to have a salary on top of the vesting cycle for your practice. You typically will also have a business development bonus for continuing to bring in new business because buyers want to incentivize sellers to help grow that book of business. Um, so, this is all factors which come in with the longer term succession plan. It's still an acquisition. It's not a merger. We're not just reassigning your equity in comparison with the other party's equity. We're liquidating your equity, but we're doing that over a period of time. Other advantages to over periods of time deal structures rather than more cash up front is the valuation can be higher. If the buyer has more time to work with the operating cash flow of your business and to upsell and support your clients' growth with their infrastructure and their expertise, it's quite likely that a broker like myself can help to negotiate the total value of your firm up, can help to negotiate your salary and the other aspects of your compensation up as well. So these are some things that you should think about in deal structuring. We also talk with a lot of people who, are thinking about that 5 to 10 year timeline for an exit strategy. And, certainly if things are going well and you like operating your business and the structure that it's in today, you can be in kind of education mode about M&A in accounting. But it's also possible that the right merger, the right acquisition could make sense for you to do now and to have this longer tail timeline. And the reasons really come down to what the buyer, what the other party's infrastructure looks like, and can that actually facilitate more growth, better work-life balance, and ultimately more compensation for you over the next 5 to 10 years? And oftentimes the answer to that question can be yes. And that's just a conversation that we should have on a case-by-case basis. So let's go into one more kind of unique deal model, which I've seen, and then we're going to talk about the difference between additive, multiplicative, and exponential deals. A new deal model that I have seen recently is a three-way deal, which is interesting because typically when we think about M&A, you think about a buyer and a seller or a merger party one and a merger party two, right? But something recently which has happened in the accounting space is that we're starting to have investors that are entering into the sector. And so there's now kind of three different categories or classifications of parties to a deal. The first party is the investor, which can either be a silent investor or a strategic investor. Strategic, think private equity. Silent, think somebody who's got a pile of cash lying around and believes in the accounting sector. So the investor is category one. Category two is an operator. So the operator, think about as the partner or the owner or the manager of the book of business. And then party three is the seller or the person who is thinking about succession planning or maybe who wants to slow down. With these three parties, you have a complete deal because the investor is going to fund the exit, certainly with the initial down payment as the successor gets out of the practice incrementally is how that usually goes. And the operator is going to be the one who absorbs those client relationships and helps them bring them forward into the future, into the investor and the operator's vision for the practice. And of course, you have the model which is more typical, more anecdotal, which is you just have a buyer and a seller. And of course, the buyer in this case, in the two category model, is also the investor as well as the operator who is helping to succeed out the seller. So these are some different things. And obviously the merger is its own kettle of fish, right? Oftentimes mergers happen with no succession planning whatsoever in mind for either party. It's all about how the whole is greater than the sum of its parts. And there's a variety of reasons why a merger might be relevant. We tend to see them less often than acquisitions. Acquisitions are more common because typically the reason why people liquidate or are looking to, transact on their practices as a part of either being burnt out of the accounting sector or because they're looking towards retirement. Mergers are much more about strategy and growth. And that's a perfect segue into the last topic that I want to talk about, which is this additive, multiplicative, and exponential deal structure types. Let's start with the additive structure. So the additive structure is what we see most commonly in accounting firms of old buying other accounting firms, which is, let's say I'm a $100 million accounting firm and you're a $1 million accounting firm. Maybe one of my practice areas is construction, and most of your $1 million book of business or construction. I'm going to buy you because you're going to add to a business line, which I've already built out. And, maybe I'm going to be able to upsell you on, if you're tax construction, right? Maybe I've got a CFO practice. Maybe we can do bookkeeping. Maybe you've gotten referrals from bookkeeping and CFO practices as you've been running your $1 million business. So you haven't wanted to offer those services. But now that you're going to be in a combined firm and you're on your way to retirement, the buyer, me, it makes a lot of sense for me to think about, okay, I can offer these other things to you. It's still more of an additive structure, though, this kind of legacy model of accounting firms buying other accounting firms, because the valuation is lower. So the strategy kind of has nodes of multiplicativeness to it for me, the buyer, but for you, the seller, you're not going to see the value of your practice really be respected in this newer model of thinking that private equity and that RIA broker-dealer type buyers are thinking about you. So let's move into the multiplicative model, which is implicated in the valuation of your firm if you're a seller. And I'm not going to get too much into valuations today. There's other webinars we've done before that are more valuation oriented. You're certainly welcome to contact me privately, and I can talk to you about the specific, my thoughts on the valuation of your firm. But the private equity entering into the accounting space has really happened in the last 7 to 10 years. It's happened more prominently in the last 3 to 5 years. And RIA and broker dealers are even more bleeding edge than private equity and family office buying accounting firms. We're now seeing wealth managers start to buy accounting firms. And this is very interesting, and it makes a lot of sense because obviously there is very strong ancillary opportunity for, if you're already managing someone's liquid wealth, being able to provide tax services to those clients as well is extremely powerful. I actually have one RIA client right now that's a $2 billion asset manager. They've retained us specifically to build out an ecosystem of CPA partners for them, because half of the time, their clients do not have a CPA who will return the client's email. So we're not even talking about strong monetization possibility in this partnership. We're just talking about having an accountant, a tax accountant who will respond. So they're not even interested in a revenue share. They just want a stable support structure for their clients so that they can provide them with good financial services. So you see how nuclear accounting is, not only to the life of your clients, but to the life of everyone, the attorneys, the financial advisors, the business brokers like me in other sectors, and the list goes on and on. You guys are so nuclear, and the opportunity for you to monetize and partner strategically is just outrageous. It's really astounding. So where was I? Let's see. So the multiplicative partnership. So the RIA, the private equity firm, they see your clients and they also see you for what it's worth. And this is where, merger and longer tail succession planning can become very interesting for you. They see your book of business and you as not something which is merely additive, and they don't value you that way. But they see it as multiplicative, because the plan, which they're very open and honest with you about, because they want to be competitive against the other strategic buyers in the marketplace, is to cross-sell and upsell ancillary services. So no longer, if you're a $1 million construction tax person, are we just talking about adding in CFO? But we're also talking about adding in wealth management. We're also talking perhaps about adding in IT support for your clients. We're also talking about adding in fractional marketing support for your clients. Especially this private equity model, which is now beginning to reach maturity after 5+ years of them being in the market. And obviously private equity has experience and platform level long-term hold plays, as opposed to venture capital, which is much more wheeling and dealing, shorter term holds and things like that. Rocket ship growth, that kind of thing. Private equity is more interested in long-term holds, and at least in the accounting context. There's not a lot of fast turnaround in the middle and the lower middle market. And this is different than the enterprise layer, right? You've seen Eisner Amper and Citrin Cooperman and other large firms that have, Grant Thornton is the most recent firm that just took a large PE investment. These larger firms that are getting PE money, The larger firms really want to see faster turnarounds, faster liquidity, the PE return on that kind of model. Whereas middle market and lower market accounting firms, the PE that are interested in that space are more interested in the expansive play. So for sellers, you don't have to be as worried if you're a $1 million or a $5 million firm and PE cannibalizing your business and taking the floor out from underneath you and everything that makes your business unique. These private equity firms actually want to see your business succeed. They want to see your clients have a very positive experience in that transition and for decades and decades to come, because this is where they see really the monumental opportunity of buying a lot of practices like yours, offering them all of these different services. And there's the multiplicative value. And the multiplicative value is certainly for them more than anyone else, but they're willing to value you higher than those public accounting traditional firms of old are, because they're just thinking about your book of business and the value that they can provide to your clients in a different dimensionality. So this is multiplicative. The last thing I just want to touch on briefly is this exponential context, right? So, additive is singular, multiplicative is a multiple, exponential is many multiples, right? And there are some private equity firms that are entering in the market now that are using AI and that have AI built into their roadmap in very interesting ways. We know half a dozen of them as a firm, and there are others that are popping up. These firms that are using AI and using technology in interesting ways, the opportunities are very, very exciting. And if you are planning to retire in the next 5 or so years, you're probably not going to get any kind of exponential value for your practice. You're probably, the best you can hope for is a multiplicative value, which is pretty good. For example, this firm that I talked about at the beginning of the webinar that sold for 6 million last week, they got about a 6 times multiple on their EBITDA, which is pretty good for the lower market. And that's a private equity multiple. And I'm not going to go too much into more detail about that because I said I wouldn't on today's call. But that's a multiplicative value, right? Because the PE firm clearly valued this accountant's book of business as all of these other services that we're going to be able to provide to their clients, and the long-term hold possibility. And that's also the fund level strategy. If you're not planning on retiring in the next 5 years or so, you could really get in on some of this exponential value. And that's where a merger, really a merger, but even a longer tail acquisition, but a merger especially into a financial services, I'm sorry, into an RIA broker dealer or a private equity buyer, someone who sees strategic value to your practice is going to give you that multiplicative merger. But the exponential aspect of it is going to come from your participation in a corporate development capacity to help them acquire and grow the practice. And that's where things get really exciting. So some of the more entrepreneurial and innovative accountants who are younger, and when I say younger, I mean under the age of 60, if you have 10 years of runway left and you're passionate and excited about some of these changes that are happening in accounting, some of these cross-selling components of the things that I'm talking about, and and the exponential possibility of working and helping an infrastructure that has this kind of vision and this kind of capability to scale and to grow, the way that you can get your liquidity and your practice, which you have built as a part of now that combined firm and helping them scale, the multiples are outrageous. I mean, they're almost venture capital level is the kind of growth that you can see. So that's the topic for today's webinar. Hopefully I've excited you, because if you are not a sleepy-eyed accountant, but you believe in the sector and you see the value in it, the tremendous value, there's a lot of jadedness in the sector, but there's also a tremendous amount of innovation and possibility. So if you're in that latter class, please contact me and have a conversation, because there is so much opportunity out there. And I certainly want to help you make more money. All right, everybody. Well, thank you for being here today. Wishing you a great rest of your weekend. God bless, and see you next time. Bye-bye.